The Fed has started cutting rates, but that could be either a good thing or a bad thing. A good thing because that means they're breathing oxygen back in the economy, but it could be a bad thing because it means they're acknowledging the economy is slowing down and needs help. September 18, 2024 was a huge day for the stock market and the economy because the Federal Reserve announced that day that they would start cutting rates by a whole 0.5%, which doesn't sound like a lot, but it's a lot in context of history. They've been on this constant rate hike for the past few years fighting inflation, and this is the first time they have finally decided to breathe some oxygen back into the economy by lowering interest rates. I want to start this off with a very basic explanation as to who the Fed is and what their purpose is. What do they actually do? So the Federal Reserve, who's chaired by Jerome Powell, who's the guy you see making the announcements on TV, it's a chair of individuals that dictate what's called monetary policy. So they have control over interest rates. They have control over the money printer because they're the ones that are actually able to print money and inject capital or take capital out of the system. The Fed has two primary objectives: to create an environment of full employment in the economy and keep inflation within its acceptable range of 2 to 3%, which is prices going up every single year. The primary tool that the Fed uses to either stimulate or slow down the economy is adjusting their interest rate policy. So they can decide to drop their Fed funds rate, which usually has an impact on mortgage rates, car loans, and just lending rates in general throughout the economy. So if they start lowering rates, that is stimulative in nature because it makes lending more attractive to the consumer. Maybe that consumer couldn't afford that house at a 7% mortgage rate, but they can afford it at a 6% rate. So it brings more buyers in the market, more people bid on the house, they buy the house and fill it with stuff. Same thing with cars. Maybe people couldn't afford that car loan at 5%, but now it's at 2%, so it just generates a lot more economic activity. Vice versa, when the Fed is raising rates, they are intentionally trying to slow down the economy because they don't want people to qualify for as many loans. They don't want people buying more stuff because that's going to create more inflation, which is the price of everything just going up and up and up. So when inflation is big, they raise rates to essentially tap the brakes on the economy, but essentially slow the economy down. And when the Fed lowers rates, it actually takes 6 to 9 months before that rate cut actually turns itself into economic activity in the markets. Because if you think about it, it takes time. They announce lowering rates. The banks decide, okay, we're going to lower rates. Then the consumer starts looking for more houses. It takes a while before they buy that house. And the lag time between when the Fed lowers rates and when it's actually having an impact in the economy is usually 6 to 9 months. Now, historically, it is the Fed's MO that they wait way too long to start lowering rates. What they do is they wait until the economy has slowed down way too much and we're almost in a recession. Then they're like, oh, the economy needs help. Let's start lowering rates. But they forget it's going to take 6 to 9 months before the economy actually gets any help from those rate decreases. So the MO of the Fed is we're about to head into a recession. Then the Fed's like, oh, maybe we should start lowering rates. And they're usually late to the dance. This is where my hat is completely off to Jerome Powell and what the Fed did at the September meeting, because even though the stock market's near an all-time high and the economy is still humming along at a pretty good pace, it has slowed. So they're almost acknowledging that we understand that there's a lag time between our rate cuts and when the economy is going to actually feel the help. So they're saying, hey, economy's slowing down. Let's give a little bit of help now. So if the economy keeps slowing, we're not in a complete hurt locker situation in 6 to 9 months and staring down the barrel of a recession. While we are very positive on these Fed actions, we also have to acknowledge the historical trends with a grain of salt. So when recessions show up, it's typically after the Fed has already started decreasing rates, which is kind of essentially where we are now, which is kind of spooky. Because when you think about it, the Fed is decreasing rates because it's acknowledging that the economy is getting weaker and it's trying to give it assistance. It's just a race of time that can they give enough help before the economy falls off the cliff. Now, we believe there are some things working in the economy right now that could essentially deliver this soft landing where it was less possible in the past. A variable that's at work in the markets now that has not been there in the past that could ultimately deliver this soft landing is just the amount of cash that is still circulating around the economy to build us a bridge to where we could avoid a recession. So when you look back at 0809, the Fed can inject capital into the markets by just money printing. And the Fed balance sheet in 0809, the Great Recession, expanded by $1 trillion, which is a lot of money. Fast forward to COVID, the Fed printed about $4.5 trillion of monetary money injected into the system, and they've only taken about $1 trillion back out. So back at the beginning of COVID, the economy really needed that money because it was an all-stop. But now essentially the economy is fully healed, yet we still have $3.5 trillion working in the system that wasn't there before. From a forecasting standpoint, we do expect the Fed to stay on this path of lowering interest rates into the end of the year as long as inflation stays in check. Now, by the time we get into next year, if the economy is truly starting to heal itself after these first few rate cuts, we could see the Fed pause because the economy might be telling the Fed that, hey, we're beyond inflation, we're beyond this recession risk, and there's enough money circulating in the economy where you don't have to lower rates all the way back down to 1% where you were before. So it could be more of a touch and go situation going into 2025. A word of caution, we do expect heightened levels of volatility from the stock market over the next 6 months. Not only do we have a presidential election at the end of 2024, which can create its own volatility, but anytime the Fed changes stance, essentially the market tries to front run the Fed, and guess what they're going to do? Are they going to cut rates by quarter point, half point? And sometimes the market's right and the market goes up. And sometimes the consensus in the market is wrong and the market has a steep drop. So investors' patience could be tested, but it's all about sticking to the fundamentals. I hope this video was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.